Hey guys, welcome everybody to episode number, I think Gary put it out there, but it was like 137 or some large number like that. Gary is not with us today. He still is in the land of the living. But he had a guest in town that he's hosting around Charlotte, having a good time. So he left Jack and I to our own devices today, which means that I don't know, we'll probably screw it up somehow, Jack, but we'll try to do our best. If you guys are longtime listeners or even new time listeners, either way, same rules still apply. Our goal here is to impart some of our, I don't even know if I call it wisdom anymore. We're probably, it's kind of our best guesses and opinions, at this point, knowing that, you can listen to a lot of advice, but at the same time, it's really hard when you're sitting in the center seat trying to make decisions. So, our job here is just to help you try to make better decisions and avoid as many mistakes as you can make, or at least, at a minimum, make those mistakes as painless as possible to the extent that you can. So with that in mind, if you guys have questions, go ahead and hit us up with questions in the Q&A. And if you just want to haze us or chat back and forth, hit us up in the chat. I think that I have enabled the chat, if I'm not mistaken at this point. So I got a little bit early to test my technology prowess here, but with that in mind, kind of kicking things off, and then I'll turn it over to Jack, and then we'll bring in our esteemed guest Ben McDonald on. Really what I wanted to talk about in this webinar. Happy to address anything that anybody wants to, but the main topic today is really just going to be around. We keep on seeing stock market movement. We keep on seeing, we did have some downturn. Now there was a little growth in GDP. And interest rates still keep on going up. Inflation's coming down, but not very fast. It's time when people have a lot of questions and they're trying to figure out, well, what's coming and what am I going to do next? At least within the time horizon that is relevant for me, which could be next year, could be the next 5 years. So we brought Ben on to address some of those questions for us. From my perspective, not much really new to report on in the tax world. I think the congressional midterm elections are really going to tell us a lot. We're only, I may have a lot to say after the midterm elections, but for now, is there a possibility that you're going to see some tax law changes if it remains, a little bit more Democratic pickup in the Senate and the Democrats retain the House? Yeah, I could see a modest increase, and I think what that would look like for a lot of the people on here. I don't think they're going to do anything worse than what they've probably already proposed. But it just means that kind of our worst case scenario probably is going to be a modest capital gains increase, and then they'll roll back some of the tax cuts and jobs acts under Trump, which for most of our clients, which are flow through entities, small business owners, S corps and partnerships, that means probably anywhere between a 5 to 10% tax rate increase, depending on what you're doing. I mean, it's not like people talk about, oh my God, it's just going to be tax and spend time. The bad news is every single administration has been tax and spend since Bill Clinton in the balanced budget of the mid-90s, and it was either reduce taxes and spend or tax and spend. But either way, it was spend like drunken sailors trying to make everybody happy and spend more money than the government brings in. So, there at some point, we got to figure something out, because you can't keep on spending your way with record deficits. So at some point, tax rates are going to go up in 2026 if Congress does nothing, meaning like literally does nothing. Our tax rates will go up because that's when the Tax Cuts and Jobs Act that was passed under Trump expires. So regardless of who holds power at that point, Congress has to take positive, meaning they actually have to do something. Otherwise, tax rates do go up. So apologies about the dog barking there in the background. I am dog sitting today, so hopefully nobody heard that too loudly. But anyway, Jack, do you have anything that you wanted to kick us off with?
Sure. So a couple things. You probably have heard that the the North Carolina unemployment rate did go up. It went from 3.5 to 3.6. It was 3.5 in August. But it's the first monthly increase since April 2020. And so again, we've talked about, it's still low. So, but it is an indication maybe of kind of where the economy is going. The other thing that I wanted to mention is that I read an article or some articles about what might happen in the elections, depending on whether there is a swing in the political power in the House. And on the Democrat side of things, if they are saying, well, what we intend on doing is taking portions of the Build Back Better that didn't make it into the Inflation Reduction Act and put those things in there. And the Republicans are saying, well, our first thing that we're going to do is we're going to scrap this money that was sent to the IRS to go harass business owners and go find money that hasn't been paid. So you have that back and forth still going on. It's been an interesting political season. I have not gone to vote yet, but I will. I may do it I didn't realize that polling places are open on Sundays. So maybe after going to church and praying for a little bit and getting, inspiration, I'll end up at my polling site. Hopefully when everyone else is at church, like maybe I'll go to church early or something. And then, kind of in like random crazy news, the title of this was "Don't Do This." And I'm just going to read you a few quotes from this. So, a North Carolina woman was cited by police for shooting a Mountain Dew can in her backyard. Gastonia Police Department noted how dangerous shooting in residential neighborhoods can be, adding guns and Diet Mountain Dew don't mix. The Gastonia Police Department responded to shots fired in a neighborhood and found a 64-year-old woman who said she was firing a revolver at the soda cans because she didn't approve of her father drinking them. And here are some quotes. We totally understand that not everybody is a fan of the Dew, but we can't stress enough how dangerous it is to shoot cans in a neighborhood surrounded by neighbors and kids and others. Let's see. There was other quotes of, "Come on, people, this is Gastonia, sun drop only, please." And then I would fully understand if it had been a Dr. Pepper, a third person said, is being quoted. So yeah, not a good idea to discharge a firearm in your backyard when you're for target practice or to let out your frustrations. So, please do go to a certified shooting range if you feel the need. So there's my public service announcement for the week.
Yeah.
I also like the clarification in the article that it was Diet Mountain Dew, just in case anybody was really curious.
Yeah. No,
Yes. Yep.
Yeah,
So you didn't have the extra sugar, but you still had that's the stuff that I drink when I'm getting, I know it's going to be kind of a later night on the road, or just, it's like that. No, I don't want coffee or as much coffee, but the Diet Mountain Dew will do it. But the blue Mountain Dew, that will burn a hole in your stomach. So don't do that. I'm just saying.
All right, fair enough. So to get back to the value added part of the webinar.
That wasn't it. That wasn't
now
the
we've got the yucks out. So Ben, welcome. Love to have you back. You're extremely helpful. The last time that you're on, which I think was about 3 months or so ago. So, time has passed. Stock market continues to seem to be having reactions to interest rates and the interest rate increases. And, at the same time, the Fed seems to be pretty dogmatic that until inflation comes down, then this is what you're in for. It seems like starting to see a little bit of an impact in the housing market. But as we're out there, as we're out here as business owners, we're thinking, what is it going to do to my portfolio? If people are sort of worrying about their retirement, are they going to buy stuff? Is my company still going to be worth what it's going to be worth? If I did sell it, how am I going to live off the proceeds if the investments don't grow? Blah blah. When everything's going great, it's all unicorns and freaking rainbows. And it's like one of those things. I know it's going to go down someday, but not today. And now, hey, we finally see some downturn. So with all that in mind, let me turn it over to you, and please help us with what, to the extent that you can, with what you know. And what I love about you, Ben, is that, I always hate those real estate agents that are like, there's never a better time to buy, market's going up, never better time to buy, market's going down, never time to buy, better time to buy. And you hear that from a lot of other wealth managers too. Market's going up, well, you need to get in there. Market's going down, a lot of markets to be had. So if you could help us out, please.
Yeah, right. It's easy for a lot of people to just find whatever narrative fits what they're trying to do, which is collecting more assets, right, in the wealth management. So they're saying, oh, you're going to miss out when things are going up, or everything's on sale when things are going down. So yeah, no, that's a good point. But there are a few different trends, and part of it is people need to be able to have the ability to zoom out, right? Markets are going to drop. You just don't know when. And logically, I have conversations all the time with people over the years where, hey, what happens when things are going up? What do we do when things are going down? And it's easy to have that logical conversation. And then as soon as things do go down, logic gets thrown out the window and emotions come into play, because it's people's retirement that they see drifting away every time they log back into their account. And so typically you get knee-jerk reactions of people over responding to something that is really quite normal, right? We, in general, see a double-digit market drop 2 to 3 times a year. The difference is we went years without seeing one. We had it in 2020, but then had all the stimulus money come in. And so nobody really felt it, right? Portfolios went up 20 or 30% because of the stimulus, because we got propped up. So people haven't felt this type of market decline in a very long time. So it's hitting a lot harder. You're getting the flashbacks of 08, even though things are different scenarios, and people are trying to figure out how are they going to be able to still reach their goals. So there are definitely indicators. And one thing on that point of things going down and how that's normal, one stat that I love of just trying to follow trends is every single time that the S&P 500 has gone down 25%, the next 1 year, 3 years, and 5 years have always been positive since like 1950 or something like that. And it's just another realization of you need to be able to step back and zoom out, because this is not an abnormal thing to happen. And if you panic and get rid of your long-term plan, it completely blows up the plan, right? Because what happened in 08, and it's why people's portfolios, if they're investing on their own, since 2000, individual investors averaging or managing their own money averaged about 2.5% growth per year, even though in that same time, the S&P is about 7.5 or something like that. And the biggest reason why is during the tech bubble, during 01, during 2008, people will sell after things have gone down 20% or 30% and not get back in until 3 years later once they feel comfortable. You do that enough times and you're not going to even keep up with inflation. So that's the first thing that I want to make sure that we're emphasizing is you need to be able to zoom out and step back, because this is not an abnormal thing to happen. It just hurts in the moment, but it's not uncommon, if that part makes sense. Mm-hmm. So I want to start with that. The second big trend that is happening this year that I want people on here to listen to and not do, 31% of Americans are decreasing their contributions into their 401ks this year. So one, that could potentially have an impact on what you're doing with taxes, right? Depending on how you're contributing. And two, could be impacting, are you getting a match from the company if all of a sudden you turned off contributions, right? So you're missing out on that opportunity. And three, you're not being able to do dollar cost averaging, right? You're not being able to continue buying as things are going down. You're missing out on all of that. So the fact that almost a third of our country is decreasing their contributions into their 401ks is going to end up being a massive mistake for a lot of people, because they're not going to be able to do that dollar cost averaging throughout this market downturn. So that would be the second trend that I would tell people to make sure that they're cognizant of and taking advantage of things going down, because we don't know when things will come back. You can't time the market. Adam won't share his crystal ball with me. So what you need to do is you need to stop trying to guess when things are going to go up and when things are going to go down. And you need to be able to stick to what your long-term plan is. And if you don't have a long-term plan, then how would you ever expect to handle any sort of market volatility, right? You can't expect to maintain composure if you're just flying by night and you don't have any idea or plan of what you're doing, how you're going to handle when things are going down, how you're going to handle when inflation is up, or when unemployment starts to increase, or when mortgage rates more than double. If you don't have a plan for those things, you're going to get yourself in trouble.
So Ben, we've got, if you could help us out, just kind of like, because a lot of these questions are more around, stages of life. So I'll ask you just, kind of some stages of life type questions. The first stage of life is the one where I would say, I'm probably, the most scared, which is, I have retired.
Yep.
I probably could be a Walmart greeter, if things got really bad, or I could scale back my lifestyle if I really wanted to, or needed to, but otherwise what I've got is what I've got.
Yeah.
What are you telling? And that could be a person that just sold a company, or it could be a person that just retired, or it could be someone that retired years ago. It's just what I've got is but yet I retired, on an upturn because we just had a historic, bull market. So what do you tell that person?
Yep. So basically the person who's now relying on their portfolio to live, right? It's not that they're not touching it. So for that person, I was talking about making sure you have a game plan. The game plan for that person is no longer market growth as much as it is your income stream. Where are you getting your money from? Doesn't mean that you're not also going to grow at the same time, but that's a secondary plan. Your primary plan is how do you pay your bills? How do you live the way that you want to live without having to cut your lifestyle, or without having to go back and be a Walmart greeter? So one of the biggest differences that we do with our portfolio management for that type of client is, how are you looking at the income from the portfolio? The rule of that 4%, if anybody has ever heard this, you can take 4% of your portfolio and be able to sustain that. Well, if you're taking 4% of your portfolio, congratulations, you just got a 25% pay cut, because your portfolio is now worth 25% less than it was. Your 4% is now 25% less than it was. I think that's a very backwards way to look at it. What we're doing is trying to go with extremely high quality investments that pay consistent dividends that are based on dollar amounts. So equities, for example, stocks, exchange traded funds, their dividends are based on a specific dollar amount. You own one share, you get $1 for every share you own, right? Whatever that is. Well, the stock price or the fund price in that could fluctuate, could go down 25%, could go up 25%. But if you're choosing investments that have consistently been able to maintain or ideally increase their dividend, then it doesn't matter what the value of your portfolio is. Your income is the exact same because you're living off the dividends. You're not living off of the principal of your portfolio. And that's something that not nearly enough people do in that stage of life, where they're actually using their portfolio to live. Like I said, it's easy for people to say that 4%, and yet they're not even factoring in the fact that they're going to get a pay cut every time the market drops. And on the flip side, when the markets go up, they're going to get a pay raise, but now they're taking money that they don't need. And if that's money out of their IRA, now that's additional taxes, things like that too. So building a portfolio strategy that has consistent dividends, and I mentioned the rising dividends, right? Or companies increasing their dividend. If you can also, in this time with inflation, if you can find companies that have consistently been able to increase their dividends, even through things like COVID or the recession of 2008 and things like that, at a higher rate, a 6 to 10% annual dividend increase, now not only are you maintaining your income, but you're also keeping up with inflation as your as your income increases at that same rate.
Okay. And for someone like that, I mean, what are your thoughts around, borrowing against the portfolio or borrowing against, equity in your house, or just, some taking on debt,
Yep.
in order to preserve the growing asset value, and you're not kind of forced into a sale situation, or maybe that's not a good idea, but
No, we actually use it a decent amount, for a couple different reasons. One would be, hey, are you making a deal? Are you buying commercial real estate, or are you buying a house and then selling your own house and you just need money for a few months? Well, instead of selling and getting hit with capital gains or getting hit with distributions and paying taxes, if you can borrow in that short term off of the value, be able to use that, have a little interest accumulate, and then pay it back off, that becomes a no-brainer, right? It becomes very easy to do. The one thing, though, that's happening right now, not only as you see markets declining, but it's also a weird environment where we are at the same time seeing interest rates going up pretty significantly. So now debt is becoming much more expensive. And it becomes more complex of, oh, do I borrow against my portfolio if margin loans are 7% a year and I'm not going to be able to pay it back for a few years, right? That then becomes a different type of conversation. And you have to weigh a few different things. You've got to weigh, what is that timeline? Are we going to be able to have the markets recover? And in that timeline, which would be greater than what your cost of borrowing in theory would be. The second would be, what would be the ramifications of selling? Meaning, what would you be paying in taxes? Is that more expensive than borrowing for that period of time? So those would be the two things that I would think about. Is one, what are those ramifications of not borrowing? And two, what's your timeline of being able to borrow?
So kind of next scenario, Ben, is that, you've got a lot of people that have been, contemplating sales because, they're getting up there. They're not spring chickens. So these are, kind of our 50 some odd year olds, some 60-year-olds that are thinking, okay, it's time, or maybe even 70, but it's time to transition out. And again, same sort of question. I'm going to have to live off this portfolio. How are you modeling, and what, could have had some maybe I modeled out, 6% growth or 8% growth before. Maybe I don't model that out. Like, what do you do differently, now in terms of trying to help somebody even determine whether their assets are going to make it, or not? Because that would influence, like, I mean, if I sell the company, for, $1 million, but I've got 20 years to live off of it, but, pretty low lifestyle, but I'm assuming an 8% growth rate, but then I'm not assuming that anymore. That's just a different, that changes my calculus on whether or not I can do it now versus whether I need to wait 3 or 4 years.
Yeah. So one thing that I'm fortunate that I've done pretty much throughout my career, and we definitely do it here with BGW, is whenever we're running different types of projections or building a financial plan, all of our estimates of returns are at least 2%, if not 3% below what the average return has been, right? So if you've got a portfolio that historically has returned 7%, we're probably building in that it's only returning 4.5 to 5.5%. So that's one, is we always want to paint an almost worst case type scenario. So that way you can plan for that, and everything excess is just gravy on top. So that would be the first thing. It's easy in the wealth management industry because people want to make their clients feel good and they want to get their business to grow, to paint the best picture possible. It's like, oh, look what it'll be like with me. Everything's going to be amazing and we're going to get 9% return a year. And then that doesn't happen and you start backpedaling. So if instead what you're doing is you're planning for what happens in a worst case scenario, from market return, from a life event, if you have a long-term care type need come up and all of a sudden you have this massive expense, there's all of these different scenarios. You need to stress test your plan and your portfolio. You need to see what's it going to look like in all of these different potential landmines. So that's where I'm starting with everybody, that they're not retired yet, but they're thinking about it, they're close to it, they're planning it. that's the first thing we're doing, is we're stress testing every possible scenario that could blow up their plan. And then after that, once you get to that point, and then we get more granular and start looking at the actual investments or types of accounts and portfolio strategies, if they're still years out, we're positioning, especially now, we're positioning portfolios for the recovery whenever it happens. Are we doing Roth conversions, or do we want contributions going into the Roth instead of the traditional if it doesn't impact their taxes in that current year as much, and partnering with the CPAs in order to do that? Are we doing tax loss harvesting now so we can build this tax asset that we can use on future gains that we can carry forward? That would be the next iteration after you stress test, is how do you then plan for the recovery, and how do you best position yourself for it?
Okay. How about, kind of 30s and 40s, is that kind of smooth sailing or not smooth sailing?
The more you can invest, the better.
Yeah. Like stop worrying, jackass.
Yep. And most, if not all of my clients that are younger, that are 30s and 40s, they all are pretty aware that this is more of an opportunity for them than it is for somebody that's only a few years out of retirement, or somebody that's in retirement, right? This is the time, like I was talking to somebody yesterday, and this is not making a recommendation to go buy this, but I'm just using this as the example. Microsoft went down a lot yesterday, so it's been down 33% from its high. And the client's quote was something to the effect of, Microsoft's not going anywhere. It's just 2/3 of the price of what it was 6 months ago, or whatever he said. And so that's been the mentality more so for those types of people, is you invest in high quality investments that you feel very confident are going to be there. You try and take more advantage of this than you worry about how to protect against it. So that's the mentality really for those type of clients for the most part.
Okay. Well, Jack, any questions for you before I keep on firing away?
Yeah, so I was thinking about, you'd mentioned, don't start selling stuff and reducing your contributions 401k. One thing that I hadn't really thought about, do you end up at a point where you've messed up the matching requirement for your employer? So that's a very good point to check into if you are anticipating doing that. But I guess my question is that, as far as the next evolution of hard assets, so whether it be in a car or your house or second home, you're at a point where, should I downsize? Should I trade in my nice Cadillac for a new but lesser vehicle to maybe get some cash and reinvest it? So are there certain assets that you would say, yeah, it's probably a pretty good idea to liquidate those assets, because all dealerships are looking for used cars? The housing market obviously is high at this point. It's coming down, I think, a little bit, but it's really a seller's market at this point. So is there any evolution of assets that you would maybe say, yeah, those may be more prone to liquidation, just to generate cash to invest in, like an ETF or something else?
Yeah, so a lot of that's going to have to do with the debt on what you have and what you would be buying. So let's use houses, right? So this was the easiest conversation in the world 3 years ago, when you could sell your house that is doubled in value and you could go get a 2.5% 30-year fixed mortgage, right? It was a no-brainer. And now you're giving up that 2.5 or 3% mortgage, and you're going and getting, I looked yesterday for today's call, 30-year fixed mortgage, depending on obviously what your credit is, but is somewhere between 7.2 and 7.7%. So even if you're selling at the high point and you're able to cash out and downsize and get to a smaller place or a less expensive house, if you're giving up a 2.5 or 3% mortgage and you're going to a 7.5, depending on how much you downsize, your payment may be as much, if not more, because debt is so much worse. And it's the same thing with, you mentioned automobiles, right? So it's the same exact thing with that, just rates are typically higher. Personal loans obviously is another. So all of that, my conversation around these things with clients is more focused on the net of it all, meaning what are you getting? What are you buying? What's the debt? And how does that net out? I think that's the biggest thing to consider there, more so than a specific asset class.
So we've had a couple questions that have come in. The first one is from Robert Maeda. Robert, thanks. Adam, what's the tax rate on dividend income versus ordinary income? So first point of clarity, because this always confuses owners of S corporations and partnerships, because in S corporations, the cash that you take out as distributions, some people call dividends. Some people call it dividends from a partnership, even though their member draws. Like, well, if I leave the money in the company, it's not taxed, right? It's like, no, it's a flow through entity. You're taxed regardless of where the money sits. So you might as well take it out and put it in your pocket. Anyway, we're talking about dividends on investments, which are generally speaking going to be publicly held securities in this case. In this scenario, dividends are either ordinary dividends or they're qualified dividends. The difference between the two is that qualified dividends are domestic, so it means US-based corporations. So there's an incentive to invest in those types of companies. Those dividends are taxed at 15% if you're below an income threshold, which I think is about $250,000, or 20% if you're above that threshold. So they have the same rate as your capital gains tax rate. That's if they're US-based securities. If they're foreign securities, they're at your ordinary rate, which is just whatever your ordinary rate actually is. So that was question number one. So again, you got, if you're going for investment income, via a dividend payment strategy, which this is off the top of my head, Ben, but isn't like the average dividend yield something like 3 or 4% of market value or something like that? Like it's somewhere, I always thought it was somewhere in that range. I mean, like if I had $100 invested, I should, and it's in dividend yielding stocks, I would expect kind of $3.
Yeah. So for dividend specific, yes, it gets more than that. There's kind of a few different iterations. So there's growth stocks like Amazon, Google, those companies don't pay any dividend. There's going to be a growth in income. Think Microsoft, Apple, those types of companies. They're going to be increasing their dividends every year because their cash flow is great and their revenue is consistent, but they're only going to pay, say, 1.5%. And then you get more income type stocks, and those tend to be closer to like the 4% or so. So yeah, average would probably, my guess off the top of my head, would probably be somewhere close to 3.
Yeah. Okay, cool. So then the tax rate on that would be 15 to 20%, depending on your income level. And then Joe's question, which I think we probably would say true, is it true that money can be made in the market regardless of whether it's a bull or a bear market? That's a Ben.
Yeah. So, and do you want me to click? Oh, you got it. All right. Yes, you can, right? There's always things that are going differently than investments, or than the stock market. In the past, that has been a lot of times people go to bonds, right? Stocks are going down, bonds are going up. That's obviously not the case because this is a little unique of we're getting hit with such high interest rate growth and inflation at the same time. So you're seeing bonds are down 17% or the value of bonds are down 17% when stocks are down, S&P's down 20, NASDAQ's down 30, right? So there are other ways to make money though. This ironically has been a better year for traditional hedge funds because hedging and shorting investments, in the hindsight of everything going down, has worked pretty well, right? Because if you short an investment, that means you're betting on it going down in value. So there are those types of strategies. There's always places to be able to make money. It's not as straightforward with what we're seeing this time compared to what it has been in the past. So for a lot of more traditional investors that aren't shorting or hedging, or we're not doing a lot of derivatives or options, things like that, there's significantly less place to make money. Without getting into really sophisticated investment strategies, it becomes more of how do you outperform? How, when the market is down 20, are you down 12? Right? Those types of things. It becomes more about market outperformance and less about just net growth in a time like this.
And how, kind of last question I had, you keep on saying, Wall Street really is just upset about this whole interest rate thing. And I'm not saying that in a derogatory way, because, I think it's crazy. I don't like my interest rate going up either, because I've got some variable debt. I understand the theory of what they're trying to do here. And I've got my own opinion on, do we actually have the ability to control anything through any factor, whether it's tax rates or interest rates? And my Adam's belief for those on the call are no. It's funny and comical when we think that we can control, markets. But, that being said, how long do you, what's kind of the thought process around, I doubt it's anything as linear as if interest rates continue to go up, the market will continue to go down, but sort of what are you sort of seeing as an association there? If people are kind of thinking around, well, I know I'm supposed to stay in, but how long should I, how long is it going to keep on going? Kind of questions like that, knowing that nobody can know, but is there any sort of association that we can draw upon, or is it just, irrationality?
Yeah. So you're right. We obviously can't tell that. We don't know, but what we've done is try and pull in from as many high quality analysts and companies as possible out there, in addition to doing our own research. So a lot of what we've seen is, as far as their outlooks, has been milder recession lasting an additional 12 to 18 months from basically where we are now. Inflation starting to get more manageable in 2013 or 2023, not 2013. Maybe settling to like 5 to 6.5% instead of the 9%, 9.5% type range. That's been a lot of what the analyst outlook has been. Of, you'll see the foot come off the gas a little bit with inflation, but it won't go back to normal, say 2.5%, 3% type rate. And so that's going to elongate the economic downturn, whether it's officially called a recession or not, the slowdown or less growth, because you're seeing things like cost of goods sold are increasing for companies, and the what's called pay rates for people are going up because it's trying to keep up with their cost of living. And companies that have a lot of debt, their debt is renewing, and now it's renewing at a much higher rate. So it's eating into these companies' profits. So the longer that inflation continues at a higher than expected or higher than average rate, that will elongate the recovery. Does that make sense? Because that's the correlation there. You're right. It's not a direct correlation. It's just think of inflation or interest rates rising as like a drag on a company's net performance.
Yeah, no, that's true. I mean, because you're paying more than you were yesterday through no fault of your own. It's sort of like the same effect of a tax rate increase. It's just a consumer cash flow that it's, I equate the tax rate increase and the interest rate increase sort of like buying new tires. We're not looking to spend money on that. And it's certainly not any fun. And I don't care what anybody says about, but the quality of the ride, so much. It's not looking to spend $2,000 on a set of tires. Not looking to pay 0.5% more for interest for no real reason. It was the same money. So anyway,
it's part of why we've seen really large, healthy cash flow companies do significantly better so far in this than smaller companies, because their debt and their access to better rate debt it's not proportional at all compared to smaller, even publicly traded, but smaller publicly traded companies. Their access to the same type of debt it's not comparable. So we've seen larger companies, healthier cash flow companies in especially the United States, but Asia as well, excluding China because of their governmental control, they've dramatically outperformed smaller companies, and that's a big reason why.
Right. Well, cool. Well, Jack, you got any questions for Ben? And then we'll also ask any of the attendees if you guys got any questions for Ben, as we're getting close to the top of the hour here.
Sure. So one of the questions I get occasionally is, and I'm very clear that I am no way a financial advisor or anywhere in that arena. So I punt the question, but it seems to come up with maybe the younger crowd of clients that say, do you know anything about these? And I don't know what they're called, but I would call them retirement age appropriate funds. So like 2035, 2040 funds.
Target date funds.
Okay. And so my understanding of that is that basically what they do is based on your age, they assess a certain risk profile to you, and then it gets adjusted as you get older, kind of like on autopilot as to when you're younger, maybe riskier investments to more conservative investments over the course of time. I don't know if that's accurate, but I seem to be getting that question more often in the past 12 months or so, more so with the recession is that a good investment? No, is that a good investment? To me, it's kind of like, well, you're kind of, I don't want to say being lazy about it, but I mean, you're relying upon your age, and I don't know how much thought process goes into one of those funds. And you may say, well, it depends on whose fund it is. That makes a difference. I recommend that they go talk to an advisor, because it may be appropriate for them, but maybe, for whatever reason, maybe young high income earners may want to take more risk than what the risk portfolio would put together for them, or maybe they need to be more conservative. Maybe they have some elderly parents that they need to make sure that they have some more liquidity than what that fund would provide. So can you kind of give a little background on that, just the process, and generally if it's something good? And I guess you're probably going to give a very legal answer, which is it depends. And I say that a lot.
So you're right as far as how it works, right? So let's say they're going to retire in 2050. Their portfolio inside that target date fund may be 80% stocks, 20% bonds. Their target date fund is 2025. It's probably 40% stocks and 60% bonds. So as you get closer to the date, you're exactly right. It will scale down its risk. A lot of times the investments inside, or at least most of them, are the same. It's just the weighting percentage are different. So that's the basics of how target dates work. The part of it depends, it's correct only in the way of you need to do a check-in to yourself. If you're going to go into your portfolio and log into your 401k and look at the investment options and figure out what the best options are to choose and build out a portfolio that fits you, yeah, absolutely. That's great, right? That's what you should be doing. If you either can have an expert that's going to help you with that, or you're willing to go do that yourself, and you're willing to go in there and rebalance on a consistent basis when you need to, and those types of things. For the people who aren't willing to do that, or just don't feel comfortable doing that, that's where target dates really come in, because otherwise you don't get the consistency of things like rebalancing or scaling down your risk as you get closer. And so the autopilot feature essentially of the target dates is for the person who wants to be hands-off, doesn't want to have to worry about their login and their rebalancing and that type of stuff. They just want to know that they're getting exposure to the market. That's where target dates make sense.
All right. Any questions from the audience? Looks like we got two. I need to be better on this Q&A.
First off, thanks, Joe. Yes, I probably would be considered either anal or OCD or something. Yes, the color coding of the background it's a little bit of OCD, a little bit of it's a nice Zoom background meshed into one.
Yeah. So I've learned about the color coding, and it's like I love, when I say love organization, I am not highly organized, yet at the same time I love it when it is organized. So there's a series on Netflix called Home Edit, And their big thing is organizing by color. So there you go, Ben. Had you thought of that 3 years ago, you could now have a fabulous line of containers and books now sold in your local Walmart. Anyway,
We'd be having a very different conversation today.
yeah, and the boat, and we could say the Boatman family indirectly support you because we buy a lot of that stuff. Anyway, so this is from Andrew. What advice do you think can be given to companies with a lot of companies who have contracts for revenue? It's a good question. I'll take a first crack at it. It's and Jack, maybe you could chime in here too, but I mean, at the end of the day, like, I love, people that have contracts, it's great. And yet at the same time, you could still not get paid, so I think, and even though ultimately you may win on the merits, you could still not get paid, or only get paid a fraction of that. So, I mean, technically, if I do somebody's tax return based on the engagement letter, they have a contractual obligation to pay me, yet some surprisingly don't, So I just think from that perspective, the same good old fashioned, principles apply in terms of just making sure that you feel pretty secure that those contracts are actually still going to be timed correctly and go through as you are counting on. What do you think, Jack?
Yeah, so I look at that question or that issue through two lenses, but it's ultimately the same process that you should have to go through, which is basically what you just said. So from like an M&A perspective, or sale of business, purchase of business, so I'm representing buyer's counsel, I'm going to look at the what are called material contracts, the contracts that have some longevity, that are maybe what bring in the most revenue. And I'm going to look at what the terms are as far as the actual term of the agreement. I'm going to look at what the cancellation provisions are. So this is basically, I'm training you in this moment as to what I would tell a young associate who's reviewing material contracts, which is, these are the things that you're looking for in order to see, is the value, the purchase price appropriate for that, for what we're buying, and including the longevity of the relationships. So part of that is also, what is the past history of collections and issues with collectability. So if you have a contract, but you're carrying an AR with a late payer, or you're having collection issues, those kind of things, that impacts the value of it. So, you want, and so outside of the M&A context, so just in every daily business operations, you want to have clean contracts. You want to have a good relationship that requires discipline. So I will tell you straight out that the worst part of my job, or the least favorite part of my job, is being a credit manager of a legal business. And I mean, for me personally. So I, on a daily basis, when I bring on a new client, and making a credit decision as to how much work I'm going to do. Am I going to take a deposit and hold their money? Am I going to take fees in advance, which really is money that gets applied to their bills? And then afterwards, it's okay, maybe they haven't paid their bill on a timely basis. Am I going to continue to do work, or cause work to continue to be done for this client by an associate, by my other partners? So I'm being a good credit manager and protecting their time and making sure they get paid for their time, because let's face it, what their collections are have an impact on their compensation at the end of the year. So if I am the billing attorney, the responsible partner for collecting those funds, if I don't do a good job in collecting the funds that represent the work that they did for my client, that I have the client relationship, then I've let them down. So similarly, there may not be that direct causal relationship with you and your employees, or the people that work for you, but the causal relationship is, what do your books look like, and what is your ability to pay out bonuses and pay compensation, and to reinvest in yourself. So it's a long-winded way of saying basically what Adam said, which is that you need to pay attention to the books. You need to have good relationships, good contract management, good financial management, for just to continue to run the business, but also and if you're looking for a transition, And then the middle ground is you're looking for an investment. Certainly a banker is going to look at your books and say, okay, tell me what you got going on, because they're looking to, what bankers really do other than loaning you money is they're assessing risk. And they're assessing what collateral they can grab at. In addition to the obvious, which is, buildings, personal assets with personal guarantees, but also how the business is structured, because they get a security interest on everything, on the receivables, on these contracts, everything else, so that they literally they don't like to step in the shoes of the business to liquidate these assets, which would include receivables in the worst case scenario. So again, some discipline within the business to make sure that these contracts are sound, because that is definitely one of the key things that we look for when we're buying a business, but also on the seller side, as part of the prep for putting the business out on the market, as part of the cleanup to, some people say to make the business more sexy, is you have to go through this process. And there have been times where I've said, okay, you've had this relationship with this company. I understand decades ago is a ladies and gentlemen's arrangement and the world worked that way. In this day and age, it doesn't work that way. You need to memorialize that arrangement with them. And they come to find out that, okay, well, maybe, there's some negotiation has to go back and forth to do that. But at the end of the day, they have a piece of paper that says, this is the relationship. It's a 3-year term unless somebody screws it up. And that has value in the business for a banker, for an investor, for a buyer.
I'll follow up with a question that Andrew had before I get to Bruce's question. In the time of rising costs, there'd be lots of pressure on the profit margins. Yes, I mean, again, kind of combo between me and Jack. It's like, that's a tough one, because your customers, like, they want to de-risk, and de-risk means not my problem. So you just gotta, from what I've seen with our own clients that are faced with the same issue, they've just got to really try to deepen that relationship with the customer to find out, look, I mean, stuff has kind of gone up, yet we're on a fixed price contract, yet I'm going to go out of business if I actually do the work. Can you work with me, here, or, even if there are provisions, within the contract that allow for, some sort of adjustments due to pricing. I mean, just slapping that on somebody without a conversation, you ought to at least give them a heads up. Jack, anything you would want to add to that one?
No, I mean, I totally agree with that. It's a matter of transparency and just, and really just doing the things that it comes down to this, and maybe this is stating the obvious. It's kind of like, okay, and I'm trying to say this and not, I guess it comes out in a Christian way because I am Christian, but I mean, just treat others like you want to be treated. And so, providing information that is appropriate for making business decisions and all those things that goes with customers, that goes with employees. I mean, we've talked about in the past about, how you might incentivize employees beyond just giving them cash. A lot of it has to, we've talked about work culture. So, I mean, there's so many angles to, how you run your business outside of just the financials as well. So I guess I would say that is my non-business, taking off my attorney's hat, putting on a counselor's hat for just a moment.
Yeah, and I think the last question that we had here was from Bruce. Any observations on, and then, yeah, Joe got another one in there. So any observations on charity giving funds among the younger population, and when might you suggest an individual begin to use the structure? Realize that it depends on their debt burden and current income needs, but funding for charitable giving might be a hedge to begin before retirement and near retirement. Yeah, so, that's always going to be a component of what somebody wants to do from a retirement strategy is, what are they going to give to charity? I think, the couple things that I've seen, and then I'll ask Ben to chime in, and then Jack, if you got anything you'd want to add, is that, one is, if you're in a situation where you've got, low mortgage, not really a whole lot of income tax and property taxes, and you're giving below the exemption level, which is currently $10,000 per person, and you're giving like $5,000, for example, you're getting zero benefit for that from a tax perspective. So the first is, potentially look at, tripling or quadrupling your giving to get it to where you're actually getting a tax benefit. That's just a first statement, for some people that we've seen. The second is obviously, giving the Apple stock that you bought at $1 and now is worth $1,000, you get the benefit of the $1,000 deduction, even though you only paid $1 for it, is always awesome. And that same concept applies to when you go to sell your business, because you can give away pre-transaction, some of your company stock, and then the charity receives the proceeds. And we do that all the time with people, and it's a great way to avoid capital gains tax for that piece of the transaction and boost the sale. And then the last one, this is just more, related to, someone that is close to retirement or, about to do a big drawdown or whatever. A strategy is a charitable remainder trust, where basically you're donating to, a trust whereby when you die, charity is going to get the money, and you could even, give to charity along the way from that trust if you wanted to, but the income that it earns, you can live off of. So, you can still have the money invested, still have the proceeds, just like you planned on. It's just that when you die, it's going to charity and you already got the deduction for it. So anything else you'd want to add to that one, Ben?
So that part there at the end is exactly what I was going to mention on top of what you were saying. But yeah, because one of the things he said in there of like planning for retirement, so the fact that you can still live off of that interest while it's in there, but get the credit for the donation itself, I think that's a factor that not a lot of people use. And then the part of what you're donating, and Adam, you mentioned of giving stock, it's for our clients that are donating, it's the place where we are donating. We're not having them write checks to their favorite charities. We're sending the stocks that have the greatest capital gains, or if we're trying to rebalance a portfolio, we're going to be able to get rid of stocks that, or at least the lots that have the highest capital gains, so we can avoid that instead. So, how you're giving to charities is certainly a big factor that people need to be figuring out and doing the right way, or the most efficient way, I'll say.
Sure. So then the last, question we got here before we call it is, from Joe, one of the trends in my former business is to allow a client to leave if they feel that for whatever reason they're not getting the value or performance they have contracted for. Would this contract have a lower value? My own opinion on that is that, when someone's coming in and doing their diligence and their quality of earnings, and they say, well, it could cancel for any time, even though you've got these, multi-year contracts, when I'm the jerk that doesn't know your business, I would say, there's no value here because they could cancel at any time. You ought to be paying me for the business and taking this thing over. I mean, that's an extreme example. My counter to that would be, right, but has it ever been exercised? And if they're dissatisfied, they're going to cancel anyway. It's just, we're going to be hiring Jack to get us out of it, or Jack to get him on the other. So I feel like it's a red. I don't think it particularly has detracted from value from what I've seen. I think actually it's the opposite. Ends up being the sticky problem that I've seen, which is I've got a long-term contract with the customer and there's no assignment clause, that's in it. Like, we're going through that with a client now where, long-term contracts, no assignment clause. So literally every customer has to say, yes, I agree to work with the new buyer, when it comes in, which is just, that's kind of a poop fest to try to manage through, so I feel like, I don't think it's been a big value distractor or a destroyer. What do you think, Jack?
So I think it's, again, a very lawyerly answer. It depends. And I think that if there are, and it depends on the transaction. So let's say that it's a smaller business that a new owner is taking over, and you assume that the new owner is going to be fine, that there aren't going to be personality conflicts, and so people aren't going to flee the scene essentially, then that is probably okay. If there's some risk that they'll use this as an exit to get out, then that may be problematic. And so that would just need to be assessed in the due diligence process. The opposite is also potentially true, that if you have built up a reputation, I'll give you a quick example that, my son and I dive, and apparently, let's say hypothetically that a diver worked because it's under warranty and I got a replacement. So, and actually this company doesn't care. So that's the point of what I'm about to say, which is likely the cause of the issue was that I potentially did not completely seal the top when I put new batteries in it. I'm sorry, this is hypothetical. Let's say a diver did this, and then so water leaked in when you're 80 feet down underwater, and then you don't realize it and you just put the equipment away, and then you try to turn it on next and you're like, what the heck just happened? This company doesn't care. They don't care if you ran it over with a car. They don't care what happened. As long as you send them something that resembles what it was originally, they will ship you a new one. It's more expensive. Those flashlights are more expensive, but but it does have a lifetime kind of no questions asked warranty. So similarly, if it is something that is a customer benefit that is not taken advantage of, but you have maybe a higher product price, then so again, that's why it depends under the circumstances as to what the policy is, how it's been implemented, how it's been used, how it's been potentially abused, and how it might be implemented in the hands of a new owner. So a lot of factors go into it. It's not easy to say yes or no, but at first glance, if you have long-term or mid-term contracts that are so easily terminated, then that needs to be looked into and could have a negative impact if there have been issues with people exercising that frequently. So the frequency of exercising that no questions asked termination may be problematic, but maybe not. And I want to go back to the prior question, is that in addition to on the charity stuff, sometimes we have a trust and estates group here, and they will say, okay, have you thought about this? And they only because that they're familiar with the overall portfolio of this individual, that they may say, have you thought about this or that, even though you've been told this or that, not to question any reputable financial advisors, but just as, hey, have you thought about this, or have you discussed this with whoever? And so sometimes there's maybe a little bit of a change of course of action, but I say that with everything, every investment. When someone says they want to start up a new company, should it be an LLC? Should it be an S Corp? Well, I in the initial conversation, I'm not in a position to tell them one way or another from a portfolio perspective of ownership of that entity. I can tell them what the legal consequences are, but they really should seek CPA, wealth advisors advice, so that it all comes together appropriately, and you just don't basically make a decision with blinders on and not incorporating everything else that you have going on, your active and passive investments, etc.
Cool. All right. Well, any other questions before we call it here? All right. Well, I appreciate any closing comments, Jack.
I am good. We're past time, so people can go get their lunch.
Yep.
All right. Awesome. Any closing comments from you, Ben?
Nope. Thanks for having me on. It was fun again.
All right. Appreciate it, guys.
Thank you, Ben, for coming on. Really appreciate it.
Absolutely. Happy to try and be Gary's substitute for the day.
Excellent. All right. Well, thank you very much, guys.
All right. Bye.
Have a good day.
All right, see you. Bye.